Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be discussing the weekly changes in the indexes. We're also going to be taking a look at some of the losers of the week and winners of the week. We're going to be taking a look at their current expectancy for their earnings per share for the year, and then take a look at next year's and see if the growth, the change in either decline or incline was warranted, and then going forward, if I think they will kind of continue on their downwards or upwards trend. So of course the weekly recap I already posted on Facebook yesterday. S&P 500 had gone down by 0.13%. The Dow Jones also had gone down by 0.27%. Both of these indexes had been hitting record highs in the last 2 weeks. And then the NASDAQ had a very nice week, ending at positive 0.47%, and then my F&I portfolio had an increase of 0.34% this week. So very good overall. I believe I was up slightly last week, whereas the S&P 500 and the Dow Jones had been positive by quite a bit in the last 2 weeks. So it's kind of evening out a little bit. So I was paid out $98.14 just this week with AbbVie, Colgate, EPR, paychecks, and Realty Income. And then some of those dividends were then used to purchase additional shares in the New York Community Bank Corp and then TIPT inside my Roth IRA. So that's some of the information I posted up on my Facebook page. Now, taking a very quick look at some of these stocks, because I want to go in and graph them really quickly. Target, they went down this week by 5.31. They released their earnings on Wednesday and then talked about their next year estimated expectancies. And right now they're expected at $4.52 per share. Earnings per share this year. Next year they dropped it down by $4.30 per share as expected. So it looks like their drop may have been warranted kind of coming up, but I know in the Facebook groups that I kind of follow along and talk with, a lot of investors are out there asking, is it a good buy? What do you see going forward that you think this company would go up or down? And Target, Walmart, Kroger's, those brick and mortar stores that are retail, I don't see them going anywhere. People are always going to have a preference of just going to the store, seeing the produce firsthand and buying it. You can walk through the aisles, get an idea of what you may be missing in your house just by seeing it instead of having to search for it online and buy it and then wait for that to be delivered. So I don't see them going around anywhere. I think there will be a bottoming out point, and $58 for Target. We're going to be taking a look at whether that's a good price. So General Electric, they dropped down huge this week, 11.13%. They cut their dividend going into Monday. They cut their dividend by 0.24 per share per quarter down to 12 cents per share per quarter. That was a 50% cut. So they haven't done this since one of the last recessions. I don't know if it was 08 or 2000, but they've done this in the past. And they've been in the, they're such a huge company that this was very big. A lot of people have General Electric in their portfolio, especially as dividend long-term investors. So this big change to their company going forward, I still think they have some room to fall down into the $16 range, somewhere in there. I know they cut their dividend. They're trying to thin out the fat and rework their company to be profitable, because right now they're going down. I've used them in before on my fundamental charts, showing that their cash flow, that their revenue, that their net income has been going on a downwards trend. And this is one I just would not add to my portfolio. They did have this year's expectancies the same as next year's, so I don't know if I could see them continuing on that path or just kind of balancing out there. CSCO is one of the stocks that I do have in my portfolio. They released their earnings on I think it was Wednesday after hours, and they released that they had beat their earnings per share. They beat their revenue. They had declined in sales of their hardware, but they increased their security sector by 6%. They increased their services sector by 1%. I think that's great change. I would rather them not focus on being a hardware manufacturer, or hardware. I would rather them not get the majority of their revenue through sales. I would rather have them get their revenue through security and services, because that is much easier passively to kind of manage than having to go out there and promote or sell hardware. So I know for my own the company that I work for, we use CSCO all the time. implemented ICE, which is like port security, and you can do all sort of security with it. Same with StealthWatch, that's another one with Cisco. So these are some of the systems that we've implemented here and are still implementing. So I do think that their 5-day change was warranted, and going forward I do see Cisco being very profitable. So this year's estimate is $2.43 per share. Next year's is $2.56 per share. I know in the past I've talked quite a bit about Cisco and some of the changes and some of the upcoming events that they do have going for them. So Fox News had an increase of 8.01% this week, and there was some news with 21st Century Fox and Verizon that Verizon was looking to purchase some segments of 21st Century Fox. And this news came out Wednesday or Thursday, one of those days. I remember reading into it, with AT&T and the Time Warner merger. I believe that Verizon also wanted to get some of that media inside their portfolio, segment. So Verizon's going to try and purchase some of the 21st Century Fox. I think that's great that these huge telecommunication companies are trying to diversify into the media outlet, because they have Disney and Netflix and all sorts of those companies out there, that there's a lot of money to be made in that group. And merging with 21st Century Fox with Verizon, you can do something similar to what AT&T has done with their what's it called, digital, I can't think of it right now, so I'm not going to sit here and try and diddle on that. Their current year expectancy is $2 per share. Next year they're supposed to expect $2.26 for the year, which I think is great. I do see this as going forward, so this may be one I may be tracking here going forward to see if it's worth adding to my portfolio. Kroger's is one that I've been tracking. I don't know what news. So these two, I have Kroger's and Foot Locker. I couldn't find any news on what warranted their increase by so much. Kroger's went up 6.02 and Foot Locker went up by 34.54%. You can see that the analysts actually had a decline here. For Kroger's, they're at $1.97. They're expected next year at $1.94. Foot Locker is at $3.96, and then they're expected at $3.90. So both Kroger's and Foot Locker, they're both in the retail segment, so I'm not sure what exactly caused such an increase in these two companies. So if these are in your portfolio, go ahead and leave in the comments below. If you found some news as to what warranted their change, go ahead and leave that in the comments below. That is something I would like to read and look into a bit further. Now, I don't want to dive too much into these two because I don't know too much on them, but I did want to quickly check price to yield on some of these stocks that we've covered here today. And you can see that Target is something I would consider undervalued just at face value. And then kind of looking at their free cash flow, their net income, and their revenue for the year, this one actually right here, we can see that their net income is on the downwards trend, but they're kind of turning around their free cash flow. They are up about 2.48%. Going forward, though, they're expected to continue on their downwards trend. They're expected to not have as many sales going forward. So I still think Target is a bit risky of a stock, and you can see that their price to book value is a little bit high. I believe it's over 3. Okay, so it's at 2.8. So you're still paying a 284% premium for their price right now in comparison to their book value. Now, we're going to be taking a look at General Electric, and I've used this one in the past as to show where their downwards trend has been. And you can see here in the last, we're looking at 3 years, but their free cash flow has gone down by 110%. Their annual, their book value has gone up by 4.64%. Well, actually, I don't need book value. Where's the book value here? The revenue. So these are the three that I normally track as far as progress goes. So their free cash flow has gone down by 110%. Their net income has gone down by 42%, but their revenue has kind of stayed steady at 2.72%. With the new transition that they're trying to do, they're trying to thin out the fat, get rid of some of the segments that they're not making a lot of money in order to change this company around. So I'm still waiting for them to drop. This is one that I wouldn't mind adding to my portfolio. But at this current time, I do not think it's worth adding to my portfolio. You can see that their price to book value is a 2, so you're paying about a 200% premium. So I could still see this company dropping down into the $15 to $16 range before getting bought into my portfolio. Let's see here. They are Looking at it though, they do look undervalued here for the year and kind of 3 year. Look at that huge change, but it is something that is expected just because they've had such a negative. Their free cash flow and their net income and their revenue has gone down. Cisco, if we look at the price and yield, this is one that's inside my portfolio. I'm not currently buying into it. For the year, they are up very overvalued. Or no, I wouldn't say overvalued, but they are over where their average would be, where I would invest in them. If I was a brand new investor, I would definitely wait for their stock to kind of rebalance out before diving back in. Their price to book value is at a 2.6. I bought this stock back in August around the 2.3 range, and then it's been very nice on an upwards trend here. And of course, their revenue, their net income, and their free cash flow has been at an increase here for the last 3 years. Their free cash flow is up 18%. Their net income is up 6.99%, but their revenue is down slightly, down at 2.79, and that's because I believe they've been going through some of the transitions. They're trying to get their security and their services sector up, so they are transitioning. They're trying to get rid of some of their areas, but I think this will get cleaned up very nicely going forward. And 21st Century Fox, this is something I've never really taken a look at, and I can see for the year here that their yield is currently sitting at, what is it? Oh, I'm in the percentages. Let me change it back here. So their price is at $31.15. Their yield is at $1.16%. Now this would have been a great buy probably in September when their yield was over 1.4%. Right now they shot up quite a bit because of that change with the news with Verizon. So I would wait for this one to definitely balance out. You can see that they have some swings where they constantly the price goes up, comes back down, price goes down a little bit and comes back up. So I would look for a better buying opportunity right now. I don't think it's warranted to be bought at this moment. And taking a look at their price to book value, they're at 3.5. So as a value investor, anything over 3, I wouldn't consider current value buy. And they're, let's see here, 3 years, they are down on revenue by 0.03. They are down in their free cash flow by 1.72, and they are down in their net income by 64.5%. So with their merger, if they were bought out by Verizon, this may get turned around, but right now there are other stocks out there that I would probably take a look at a little bit better. Now, Kroger's for the year, and let's go back to the original here. Their yield is currently outweighing their price by quite a bit. You can see there was a huge swing here back in, let's see here, July. So June, July, that time frame here, their price dropped by quite a bit. Maybe they had a stock split or they had some bad earnings, wherever that was. They've been on a downwards trend. They may have been bottoming out now, because there is always a bottoming out period in their price where the company, let's take a look at the price to book value. So their price to book value is still a little bit high. It's 3.3, so you're paying a 338% premium for their current price in comparison to their book value. And their price per shares is 0.18. So let's see here. Let's take a look at their revenue, free cash flow, and net income for the 3 years. And they're actually positive. So revenue is up 8.84%. Their net income is up 14.29%. And I don't think it's actually bad. I think this is a good company. As Kevin O'Leary said, free cash flow is something that's always important to look for, because that's where your dividends are coming from. So as a dividend investor, this actually doesn't look too bad. I'd let's see, what was their price and yield? Okay, so their yield does outweigh their current price. So this may be something that I would look at. Let's see, they did jump up quite a bit, so I would wait for this normalization to kind of balance back out. Maybe for them to come back down into the $22 range, but even right now they would still be considered a pretty decent buy with their, maybe wait a little bit longer, who knows. And then Foot Locker here, taking a look at Foot Locker, their price to book value is 1.74, which is not bad. It's under 3, where a value investor would look at. Their yield currently outweighs their current price. So looking at the chart for the year and the 3 year, they currently do look at a value buy, but at the same time we want to take a look at the free cash flow, their net income, and their revenue here for the last couple years. So that's not what I wanted to click on. I want to click on the percentages and just take a look at their 3 year. I like to take a look at 3 year versus 5 year or 10 year, just because I like to look at free cash flow in the current time frame and kind of going forward where it's expected to kind of go. So revenue, you can see it's up 7.69%. Their free cash flow is in the orange, so it's down by 23.9, and their net income is up by 27.69. In the year, it looks like their free cash flow is where it kind of dove down here. They are still up quite a bit. So in the last 5 years, they're still up on the free cash flow. So I would look into what had happened during 2017. 2017 hasn't been a great year for retail, and with Amazon and Whole Foods and all that. So eventually this will have like a bottoming out point where eventually they'll start generating more free cash flow, but it doesn't look so bad in the 5-year graph. And they do have a pretty good price to book ratio, where their price in comparison to their book value, they were actually a better buy prior to whatever kind of news came out that caused them to jump up. But during recessions here, you can see that back in the 2008 recession here, right here, it does fall a little bit below 1, but a 1-for-1 scale would mean that you're buying their price at exactly what their book value is at, and it always recovers back to at least a 1 book value, because the company can only hold on for so long before below a book value of 1, because otherwise the book value of the company is actually, you're paying a discount at that price. You're paying less for the price of the stock in comparison to what the company is actually worth. So a lot of these stocks here, when these recessions happen, they always kind of fall either into the 1 price to book value range before bouncing back, but in some cases they don't always fall back down into the 1. Sometimes there is a bit of a bounce back where they don't ever touch the 1. You can see here that in 2008, 21st Century Fox, they bounced below 1, but then they bounced back over their price to book value of 1, and then kind of continued upwards on their trend. Cisco here, this is one of that .com ones where who would have bought Cisco at a price to book value of 32? Whoever did that, that's probably too bad. But you can see here 2008, they didn't quite recover from their 2008 one. Well, you don't want them to fall. Or General Electric, you can see these huge spikes here. So that's just an interesting thing to kind of take a look at. So that is it. Without making the video too long, we're already at 17 minutes and 30 seconds. So that is it for this video. If you have watched up until this point, I do want to go ahead and thank you guys for watching up to this point. If you enjoyed the video, go ahead and hit the like button below. If you're brand new to my channel, go ahead and hit subscribe. Hit the notification button to get notified of all new release videos. If you have any questions about anything that was covered in this video, if you own any of the stocks covered today, Target, General Electric, Cisco, Fox News, Kroger, or Foot Locker, go ahead and let me know in the comments below if you're continuing to hold them for the long term. And yeah, go ahead and let me know. So thanks for tuning in, and I will see you next time. Have a great day.